Good morning, traders. This is your Forex market commentary brought to you by Real ECN. Today commentary, we will touch base on the euro-dollar market. The stage has been set for the highly anticipated ECB interest rate decision this week. The market is bidding big on the euro decline as investors are waiting to see to what degree will the ECB back the dovish rhetorical with easing policy. With further ado, let's explore the euro-dollar market on the technical front. Here we have the euro-dollar market charted on the 1 hour time interval. The narrative for the euro-dollar market heading to this week's trading session has been bearish after falsely breaking out from the 200-day simple moving average on the 31st. The pair failed to maintain trading momentum above the 200-day simple moving average, thus forcing the pair to reverse its short-term intraday bullish momentum. The technicals are beginning to align itself with the bearish outlook on the euro as the market expect the ECB to back their dovish rhetorical up with further aggressive easing policies, starting with an interest rate cut. So on an intra-month level, the euro-dollar bullish reversal began when it peaked out from the 1.3800 to the 1.3900 level, and this correction forced the pair to break the support floor of the rising wedge formation, which began in July of 2013. When the RSI is breaking into the 40 price value and below, this is indicative of long-term bearish outlook. The current RSI price value on the euro-dollar market is trading at 40.695. Analysis of a collection of technical indicators on the hourly time interval on the euro-dollar cross is suggestive of a temporary bearish market sentiment and recommend short positions on the euro. The euro-dollar cross opened today's Sydney trading session 1 pip below the established Fibonacci support at 1.3596, while the Fibonacci resistance is set at 1.3600. Heading into this week's trading session, the euro-dollar market continued to maintain its bearish momentum as the pair continued to trade below the 200-day simple moving average. The significance of 200-day simple moving average cannot be understated, as 200-day simple moving average contain more or less of 1 year's worth of trading data. Since the euro-dollar cross opened today's Sydney trading session below the 200 days, this is very indicative of long-term bearish outlook on the cross moving forward. This bearish standpoint is also validated on the short-term moving average front as the pair opens today's Sydney trading session in line with the 5, but below the 10 and 20 and 30-day simple moving average, which is indicative of a sell recommendation on the short-term moving average front. So now, it is important to highlight this week's risk event because it will be the catalyst that trigger volatility within the euro-dollar market entering into this week's trading session. On Tuesday, we have the Eurozone core CPI year-on-year forecast to expand by 0.9%, while Eurozone CPI year-on-year is forecast to expand by 0.7%. The CPI reading is very significant because it's well below the ECB's inflation target of 2% mandate. So a sluggish CPI reading only reinforce and support the ECB dovish standpoint in terms of implementing more aggressive easing policy. Moving on to Wednesday, we have the Eurozone service PMI is forecast to expand by 53.5, while Eurozone GDP year-on-year is forecast to read at 0.9%. Also, Eurozone GDP quarter-on-quarter is forecast to expand by 0.2%. Over in the United States, on Wednesday, we have the US ADP non-farm payroll print is forecast to expand to add 210,000 jobs, while the US ISM non-manufacturing PMI is forecast to expand by 55.5. On Thursday, we have the German factory orders month-on-month is forecast to grow by 1.3%, while the Eurozone retail sale month-on-month is forecast to grow at an anemic rate of 0.1%. Highly anticipated risk event for this week is the ECB meeting, and they are forecast to drop the interest rate by from 0.25% down to 0.1%, and we also have the ECB press conference as well. Friday, we have the US non-farm payroll forecast to add 218,000 jobs, while the US unemployment rate is forecast to tick a little bit higher to 6.4% when previous reading was at 6.3%. So now moving on to the fundamental aspect of the Euro-dollar market. The greenback demand picked up heading into this week trading session with the revised May ISM manufacturing PMI growing at an expansive pace at 55.4, despite the print coming in below expectation. This shock factor was short-lived as traders began driving the dollar higher. In addition to that, the yield curve on the 10-year Treasury yield has rose above the 2.5% while the S&P continued to tick higher. However, in the Eurozone, the single currency continued to trade lower against the greenback on a series of disappointing Eurozone and German reports. On Monday, the German manufacturing PMI ticked lower, coming in at 52.3, while expectation was at 52.9. Eurozone manufacturing PMI also fell below forecast by ticking in at 52.2 when expectation was at 52.5. In addition to that, the German CPI reading contracted by 0.1% when forecast expects a 0.2% expansion. Anemic inflation growth was the core reason to why ECB cut its main refinancing rate back in November, and it's the growing fear of deflation that has cornered the ECB into implementing further easing policy. This is why the market has begun pricing in a rate cut by the Eurozone benchmark rate from 0.25% down to 0.1%, as well as the introduction of negative deposit rate to force commercial banks to lend more. Failure to implement this negative interest rate policy would only trigger a near-term Euro-dollar bounce. The second fundamental factor that holds great influence over the Euro-dollar market trend direction is market sentiment toward risk appetite. Despite the Euro-dollar recent price action breaking below its multi-month rising wedge formation, this holds true that the driving force behind the breakout is due to the ECB aggressive easing policy. However, the nature of this breakout appears to lack strong conviction. One reason behind this is the VIX index continued to remain at a multi-year low, and volatility tend to remain muted when central banks flood the market with liquidity through this stimulus program. Thus, it is this very aspect of risk appetite in the marketplace that has been the driving force for the European equity market to tick higher and the yield curve of periphery European bonds lower. This capital investment into the Eurozone may hinder the degree by which the Euro-dollar bearish momentum can hold onto the peer's trend direction. It is also important to note that the spread between the peripheral European bond and the US Treasury makes these European bonds an attractive investment and the market environment where risk appetite continues to remain strong. The guarantee of the ECB to prevent a default in these peripheral European bonds will continue to attract capital inflow into the Eurozone. I hope that this commentary will prove to be helpful for our traders, and thank you everybody for listening. Have a successful trading week.